Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, August 30th, 2024. Anyone hoping for a half-point reduction in the Fed's policy rate when it releases its next policy statement on September 18th had to be disappointed by this week's economic data. Yesterday, we learned that gross domestic product grew at an annual rate of 3% during the second quarter, more than double the 1.4% rate recorded during the first quarter. So here is that report, and I have a link to it here in the body of the article. And you can see over here in the bar graph that the second quarter was more than double the first. Not quite as strong as the fourth quarter of last year, but stronger than the first and second quarters of 2023. And this morning, we found out that the personal consumption expenditures price index, the Fed's preferred measure of inflation, increased 0.2% last month and increased 2.5% over the previous 12 months. So now here's that report. Also, I have a link to it in the article. And here are the numbers. And you can quibble about, which number is more important, the ones excluding food and energy, etc. But nevertheless, these numbers came in as expected, and if anything, maybe a little better than expected. So the market was really not surprised one way or the other by that report. In short, the economy appears to be stronger than most analysts expected, while inflation is gradually subsiding. For that reason, a quarter-point reduction in the Fed's policy rate next month seems more likely at this time. That is why the yield on the 10-year Treasury note rose above 3.9% today, after dropping below 3.8% last week. At the same time, the S&P 500 index barely budged this week in response to that news. However, that's a bit misleading since one of its largest components, NVIDIA, fell 8% since releasing its fiscal 2025 Q2 results 2 days ago that were good. In fact, they were very good, but not up to Wall Street's outsized expectations. So here's a chart of the S&P 500 year to date. You can see the big drop. And by the way, that was just 3 weeks ago. And since then, the economic data has come in better than expected. A lot of second quarter results now have come out that were good. So still not quite up to where it was back in July, but close. That's why I believe the more telling indicator this week is the Invesco S&P 500 equal weight ETF, which has gained 7% over the past 3 weeks and hit an all-time high this week. So here is essentially the S&P 500 index, but with all 500 companies weighted equally. The regular S&P 500 index weights them according to market cap. So a company like NVIDIA has big influence on the cap-weighted S&P, but has no more influence than the smallest company in the equal weight index. So if we zoom in, you can see year to date, the RSP is far higher than it was back in July and didn't really pull back at all this week. And in fact, like I said, hit a new all-time high recently. As I've said before, if Wall Street believed that an economic recession was imminent, then it would not be rotating out of mega cap stocks into smaller companies, and that means the RSP would be falling instead of rising. Now, I don't talk about precious metals much, but I think it's worth noting that the price of gold hit another all-time high last week above $2,500 an ounce. Meanwhile, the price of silver fell below $30 an ounce this week after cresting above $32 3 months ago. Bitcoin also fell sharply this week since the expectation for lower interest rates should strengthen the dollar's standing against most other currencies. The fact that gold continues to rise suggests that it is now trading as a hedge against geopolitical instability that some fear may follow this November's general election, regardless of the outcome. Central bankers around the world are stocking up on gold to stabilize their currencies and protect their holdings in U.S. Treasury securities. That is the prudent thing to do, but probably unnecessary in my estimation. I see no compelling reason to believe that the world is about to fall apart. There is always geopolitical tension in Asia, Eastern Europe, and the Middle East. At the same time, the economies of those regions are so interdependent that many of the campaign promises being made now will never come to fruition. That's this week's PF video update, and I look forward to talking to you in another week. Thank you.